Welcome to Academic Gain Tutorials. In this video, we will look into the differences between operating leverage and financial leverage. A company has two types of costs: variable costs and fixed costs. Variable costs are costs that change with the level of production. For example, as the production of a manufacturing company increases and they make more products, more raw materials and labor will be required. This means the overall costs will also increase. On the other hand, fixed costs stay constant regardless of production levels. Some examples of fixed costs are salaries, rent, interest, leases, essential maintenance, electricity and water bills, and more. Operating leverage tells us about the structure of a company's costs. It measures how much a company's profits are affected by changes in sales based on the mix of fixed and variable costs. On the other hand, financial leverage specifically refers to the use of debt to finance a company's activities. It measures how much a company uses borrowed money to finance its operations. If a company has high financial leverage, it means the company has high levels of debt, and thus it needs to generate more profits to cover that debt. This metric also indicates how financially stable the company is. So, let's look into the basic differences between operating leverage and financial leverage in a tabular form. Difference number 1. Operating leverage uses fixed operating costs to run business activities, whereas financial leverage uses debt that carries fixed interest charges. Number 2. Operating leverage shows how earnings before interest and tax, EBIT, change when sales change, whereas financial leverage shows how earnings per share, EPS, change when EBIT changes. Number 3. Operating leverage results in business risk, whereas financial leverage creates financial risk. Number 4. Operating leverage increases when a firm has high fixed operating costs, whereas financial leverage increases when an organization uses more debt in its capital structure. Number 5. Operating leverage is associated with a firm's cost structure, whereas financial leverage is associated with a firm's capital structure. Number 6. Operating leverage is measured by dividing contribution, sales minus variable costs, by EBIT, whereas financial leverage is measured by dividing EBIT by earnings before tax, EBT. Number 7. Operating leverage raises the break-even point when fixed costs rise, whereas financial leverage raises the overall debt burden through higher interest obligations. Number 8. Operating leverage is managed by adjusting fixed and variable operating costs, whereas financial leverage is managed by adjusting the proportion of debt and equity in the company's financing mix. Number 9. A low operating leverage is generally preferred because high operating leverage means higher business risk, whereas a high financial leverage is preferred only when the return on capital employed, ROCE, is greater than the cost of debt. Number 10. Operating leverage affects operating profit, EBIT, whereas financial leverage affects earnings that belong to shareholders, EPS. And difference number 11. Operating leverage focuses on the efficient utilization of fixed assets, whereas financial leverage focuses on the efficient utilization of borrowed funds to increase returns. So, these are the differences between operating leverage and financial leverage. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.